Thank you for being here today, Jorge. Could you tell us more about yourself and your career?
Yes, Jasper, thanks for the opportunity to speak to your audience. Well, I am a geological engineer, fourth generation miner, and I started Fortuna with two associates back in 2004, 2005. It's been a journey. We began Fortuna with, as I said, three associates, little money, and big ideas. Today, Fortuna is a company that operates in two continents, 5 countries, and employs close to 6,000 people or workforce who makes Fortuna happen every day. Our shares trade in the Toronto Stock Exchange and the New York Stock Exchange since 2012.
I mean, 2023 was a transformational year, really, for Fortuna. So, could you summarize both 2023 and also the fourth quarter of the year?
Yes, 2023 was a pivotal year, we say, for the company. We expanded, as you know, our business to West Africa in 2021 through the Roxgold acquisition. And we had been busy integrating the West African business. We were anchored in Latin America for 16 years. And this expansion to West Africa was a big event for the company, and one that sets Fortuna for the future. So with this acquisition, there was an integration that took place successfully, and also a construction. The Roxgold acquisition came with the Seguela project, and in September of 2021, we made the construction decision on Seguela, and in mid-2023, we delivered on time, on budget, a successful new mine. So this second half of 2023 has been the start of contribution from the Seguela mine to our business. And, capital investments also coming down, as we do not have the capital associated to a construction. So what we say is that we entered into a harvest period. No, we've been seeding the company for the future, building a new mine, and now it's time to harvest. So in the fourth quarter of the year, we delivered 136,000 ounces of gold. That's a gold equivalent. That's a historic record for us in terms of quarterly production. For the year, we delivered 452,000 ounces of gold. That's also a record, a historic record for us. But more importantly, we generated in the fourth quarter $66 million of free cash flow from operations, which is consistent with what we delivered in the third quarter of the year. So, we delivered $70 million of free cash flow from operations. So we have meaningful production, strong margins, helping us generate strong free cash flow. And more importantly, perhaps, Jasper, we are providing investors with strong optionality. The average gold price at which we sold our metal in the fourth quarter was $1,990. No? Today, we're seeing prices of over $2,100, 18 to 2,200 per ounce. And so the company is in a very good position after, as I said, an acquisition, a construction, and now we're harvesting the benefits of all that work and investment. We don't provide guidance for free cash flow, but, we're guiding for a production of, 460,000 ounces this year, in the range, between 450 and 500,000 ounces of gold. That's the range of our guidance for 2024. we're guiding for costs that could be, landing around $1,550 per ounce. So yeah, you do the math, and we could be in a very strong position.
You have now demonstrated recoveries in line with the feasibility study for Seguela. And you've also increased the throughput, and you're now guiding for 1.46 million tons to be put through the mill this year. What debottlenecking exercises will you carry out in 2024, and do you think it's upside to the throughput?
In every design, we always build, or with our construction teams and partners, spare capacity in every, component of the design, right? Because all of our designs are based on estimates of rock hardness, rock type, and all sorts of things that go into those equipment designs. And, all of us across the industry always try to capture those opportunities once the mine is in production or the plant. And it's not always the case that you can capture all of them. And in this particular case, at the Seguela mine, our team has been able to capture, all of those opportunities. And as we exited 2023, only with 6 months of production under our belt at that one mine, the plant was doing 26% better than nameplate capacity, 26% better. And I can advance to you that today, we're doing more like 35% better than nameplate capacity. So we're very, very happy to see that. It's been excellent work done by the team. And the bottlenecking opportunities remain, because basically what we've been doing is optimizing the process. And through that optimization, fine-tuning of the process, is that we've been able to capture these opportunities. We still have the expectation that with some debottlenecking, for example, on pumping capacity and small items like that, we can still get a bit more out of that plant.
So this year, you will not only be mining, you will be mining from the antenna pit, your main or in your starter pit, but you'll also bring in the Ancien and Koula pits this year. So the strip ratio will be higher, but the grades will hold up around 3 grams per ton. How will the mining vary over the year in terms of grades, and when will Ancien and Koula come into full production after being pre-stripped?
In the second half of 2023, the first 6 months of production, we have benefited from low strip ratios and short haulage distances at the starter antenna pit. Our life of mine strip ratio is around 12-13, life of mine. In the first half of the year, our strip ratio was 5.5. For 2024, we're guiding a strip ratio of around 8. So yes, we're gonna the antenna pit will remain the anchor pit for production. And in the second half of the year, we'll see ore coming from Ancien, where we're currently doing stripping, and some initial stripping taking place at Koula, where we're currently doing infill drilling. In fact, we're complete now with the infill drill program, right? So, that is the sequence. We'll have those three. Antenna will remain an anchor to production for the coming years, and then we'll have the other contributions from Ancien and Koula, as you pointed out. You should expect for the year, for 2024, and a strip ratio of hovering around 8.
Thank you. And how confident are you about that you will maintain, or that the grade will be 3 grams per ton? Because, as we saw, there was a great variability to the positive end with the antenna pit last year.
At the antenna, we were able to get positive grade reconciliation, and I think that speaks to the conservative resource reserve estimate we did. And we have done our infill drilling at Ancien, which is a following pit, and we're confident that it's aligned with our estimates, and we will be providing on a quarterly basis updates on how that conciliation really ultimately comes in line, no? But yeah, you're always exposed to upside and some risk when you mine a new deposit. In the case of Antenna, we were conservative in the estimate, and we are able to get the benefit of higher grades compared to original estimate. Will that continue? Well, it's to be seen. No, we did infill and got higher certainty on the portion of the deposit we're going to be mining through 2023 and into 2024, and then our infill will continue to go ahead and move ahead of production, and that will tell us if we are to expect more positive grade reconciliation or not. But at the end, it's something that every miner welcomes when you get higher grades than you estimated in your mine plan, right?
Could you outline the capital spending at Seguela Forest in this year?
Yes, at Seguela we have a few capital projects. The bigger one being the tailing storage facility. We are investing close to $5 million in a lift of the tailings facility this year that will serve the mine for another 2 years, right? Our total capital investments include amount to roughly $40 million in 2024. That includes capitalized stripping and as I said, the tailing storage lift and other various investments. No, but the total amount hovers around $40 million. Just
all-in sustaining cost per ounce. What range are you guiding for in this year?
At the Seguela mine, we're guiding cash cost per ounce between $630 and $730. That's our guidance for cash cost. For all-in sustaining cost is in the range of $1,100 to $1,200.
Excellent. And so, I mean, as the strip ratio increase, haul-in distances also increase. Do you think that you can maintain an AISC around $1,200 over the next couple of years, or where do you see that where do you see that going?
No, we believe that is sustainable and aligned with our expectation for life of mine cost, because capital cost will also start coming down. You're not doing lifts every year. And something important and another big opportunity that we have at this one mine is trade-off studies with respect to underground option. This mine currently contemplates only open pit mining, and some of the deposits go deep. So we're forcing the pits to go deep, and we still have resources at almost every pit bottom in the reserve. So this year we started underground trade-off studies late last year. We're well advanced with that, and that presents an opportunity to reduce strip ratios by bringing more cost-efficient underground mining methods for those deeper resources, and also unlocking the opportunity of bringing into our mine plans some of those deep resources that are outside of the bottom of the pits, right? So that's an important study we're conducting or expecting to complete this first half of the year.
So this year you will investigate the possibility of underground mining at Sunbird, Koula, Ancien.
Every deposit, we're doing trade-offs, and those studies should be complete by mid-year.
So what? But maybe you still could add some color to what mining methods, how you would potentially access the deposits, and also when you potentially could start underground mining, if the trade-off studies are in favor of that.
Those studies are taking place right now. We're looking at different mining method options: long hole, overhand, cut and fill. But it's too early for me to tell you, what it's gonna be. It's we're doing trade-offs between accessing the resources from pit bottoms or independent decline access. I mean, we're looking at a lot of options. So it will be premature for me to tell you how is it going to look.
But Do you have any expectation on sort of, do you expect the operating cost to be substantially higher on a per ton basis with underground mining?
Well, not necessarily, because if it has to offset the strip ratio, right? It's an optimization. So we would only do it if it offsets the strip ratio. And at some of those deposits or pits, we're pushing deep into the resource with the pits and getting our strip ratios high. So it has to be a trade-off. If I have an average strip ratio of 12 over the life of mine, that means that in some areas I'm mining with strip ratios of 15 or 16 for the average to be 12. So it is that end of the curve that we want to take out with the more cost-efficient underground methods, right?
Perfect. And you think that you would be able to achieve sufficient scale with underground mining?
It is an expectation, and those are the studies we're conducting.
You're guiding for 132,000 ounces midpoint guidance this year for Seguela. Based on your current understanding, what type of production profile do you think that you sort of eventually could get Seguela up to in a few years?
I already mentioned to you that we're doing, 20, 30%, 35% better than nameplate capacity, and all of that is not built into our 24 guidance. So we have a big opportunity, with higher throughputs at that one mine. But what's important to be in the mind of investors is that there is no free lunch. So yes, we are pushing the boundaries of the plant. We are processing 35% more than nameplate capacity and original design. But that also means that we have to accelerate capital investments in support of that. We need to do lifts on the tailings facility sooner. We need to increase the size of the mine fleet, right? And we'll be consuming reserves and resources at a 30% faster pace. So yes, we'll be producing more. It will be more profitable, but there is no free lunch. There's also capital that needs to be invested back into the business in support of that, right? It is a net positive, of course, but it's not everything for free.
Oh, exactly. There's nothing comes for free. But then, well, I think we have covered Seguela very well, so I think we should move on to your second producing West African asset, Yaramoko. So could you summarize this year's plan for Yaramoko?
Yes, let me remind you that when we acquired Roxgold in 2021, the Yaramoko mine in Burkina Faso was set for closure in 2023, right? So it is through exploration success that we've been able to expand beyond 2023 the life of mine. And of course, the mine did not close in 2023. Instead, it had a superb year. We revised guidance upward, and we came on the top end of that upwardly revised guidance in 2023, right? So for 2024, we are guiding production in the range of 105 to 120,000 ounces of gold. So consistent with what we did in 2023. And in terms of cash cost, we're guiding sub $1,000 cash cost. And AISC, for all-in sustaining cost, we're guiding in the range of $1,200 to $1,300 per ounce, which I believe is very competitive and well below the global gold mining industry average of around $1,400, right?
Then, yeah, as you said, so you're winding down the capex, which is why we have significantly decreased the all-in sustaining cost below 1,300. So would you now say that it's in complete it's in harvest mode?
Yes, I mean, we continue pushing with the exploration, and we continue having success. The thing is that it's not screaming success. At this mine, we've been making marginal gains. Every quarter, we bring another 20,000 ounces, 30,000 ounces. So we balance depletion and get a positive addition to inventory in the range of that I described, 20, 30,000 ounces. So it's been rewarding. The team has done an excellent job. This team has performed for 3 years without lost time incidents. No, so the mine is tightly run by a good team of professionals.
Excellent. But so if we look at the remaining reserves and resources, it would give the mine, if you would push the throughput, a mine life between 2.5 to 3 years. Or that is all M&I resources too. But would that entail so significant capital cost that you in reality think that you wouldn't mine everything that you have? If you could add some color to that.
Yes. Today we see the mine operating into 2026. So we're looking at a strong 2024 and a strong 2025 and a mine that exhausts reserves throughout 2026. So, but as I said, we continue committed to the exploration and no guarantees there, of course, but we're putting the money, we're putting the resources to see if we can not only balance depletion but expand it, right?
Let's move on to Diamba Sud. So you're drilling aggressively at Diamba Sud. 43,000 meters planned this year. But so could you summarize the plan for this year? And are you also, while doing the exploration, beginning permitting exercises or permitting work?
Yes, Jasper. Diamba Sud is an important project for us for many reasons. No, one I think clearly speaks about our commitment to the region. We didn't land in West Africa just to be an observer. So it is our second acquisition in West Africa, one that we closed in September of 2023. We closed the acquisition in September, and in November we had rigs on the site. Diamba today, help me give you perspective for a second, sits on the Mali-Senegalese shear zone, one of the most productive gold belts in West Africa. It hosts world-class deposits like Lulo, Gunkoto, and B2Gold's Fekola mine. Those are on the Mali side of the border of the shear zone. The shear zone, through the shear zone, we have a river that is the boundary between these two countries. On the Senegalese side, where we are, sits at the core of this area on the same geology, the Diamba Sud project. So Chesa Resources did an excellent job in taking Diamba Sud from a gold soil anomaly into an 850,000 ounce resource in 2 years. And we believe it can grow even further. And the first, that is the purpose of our program. Convincingly show that Diamba Sud is a deposit that can be over 1 million ounces of gold. And to that end, we're wasting no time. So as I said, we closed the acquisition in September. In November, we initiated a 45,000 meter drill program. In 2024, Diamba Sud is our largest exploration program, $11 million, 45,000 meters of drilling. That is out of a portfolio of 200,000 meters of drilling across our properties, right? So almost a quarter of our drilling will take place in this one project. It is well funded. Parallel to that, we have allocated about $3 million to engineering and environmental studies. So that critical path, which sometimes is permitting, we're moving ahead with baseline studies and those early works that take time and potentially could delay a construction decision, right? So even though we still view Diamba as an exploration project, an exciting exploration project, we're wasting no time and moving parallel to the exploration some of these early works to ensure that if and when we make a construction decision, we can move swiftly and fast track.
But so, in order to make the construction decision, what could you add some color to the permitting process in Senegal? It seems at least like it's relatively fast.
Yes, throughout West Africa, you have governments that are supportive of responsible mining and willing to work with the companies in achieving an expeditious permitting process. And so permitting timeframes are short compared to what you see, in many other parts of the world, North America, Latin America. This is much faster. But you have to do things right? Doing it expeditiously doesn't mean cutting corners, right? So that's why I'm saying that we initiated baseline studies already on biodiversity, weather patterns, precipitation, all the social aspects of the studies. So all of that is taking place as we speak, parallel to the exploration, right? So Senegal is we met with authorities. What we need to do is present a pre-feasibility, feasibility level document, and or environmental study, impact study, so they can work with us and permit, right?
Do you expect that 2025 second half is the year when you make a construction decision, or of course depending on your exploration success, but say that you don't have sort of blue sky
We're
exploration
trying to set up ourselves for that. I would say we're setting ourselves for that with this aggressive exploration. We want to deliver a preliminary economic assessment by end of this year. Remember, Jasper, that when we acquired Cesar and Diamba Sud, we did not integrate the Diamba Sud resource into our inventory. We're treating it as a historical resource and as an appendix. So we are not seeing those 850,000 ounces today in our mineral inventories. Why? Because we're treating it as historic. Before we integrate that resource into our numbers, we want to enhance our knowledge of the ore body. So the drill program has two priorities. One, do infill drilling in areas where there is already existing knowledge of the deposit, to enhance our knowledge of the mineral deposit, and then expand and test for new areas with that knowledge, right? So, Cesar was a junior explorer, an Australian junior explorer, and it had limited funding. And with that limited funding, they did excellent job. They made a significant discovery and progressed the project to where it sat when we made the acquisition. But we believe there is more opportunity that requires capital and a bit of time. So that's what we're doing. So enhancing our knowledge of the deposit with these 45,000 meters of drilling and looking for more. By the end of 2024, we should be in a position to publish a preliminary economic assessment. And then if things go well, in 2025, we should be in a position to graduate that study to a pre-feasibility level and hopefully or feasibility and make a construction decision.
So then we will move on to actually your South American assets. So Lindero, or Latin American assets really. So Lindero, you had to do a write down of stockpile ore inventory on the leach pad. Could you add some color to it?
Yes, there that has nothing to do with if we're gonna mine that or not. It's just how costs are attributed in a heap leach operation, based on average costs and things. So I would look beyond that noise and point to what's important at this one mine. What's important at this one mine, Jasper, this year, is that we have a large capital project, which is a leach pad expansion, right? So in 2024, we have guided production in the range of 100,000 ounces of gold with a cash cost of $850 to $950 per ounce, so sub $1,000 cash cost per ounce. But our AISC hovers around $1,700 to $1,900 per ounce. That is high, but it's high because we carry $400 of capital in the AISC associated to the leach pad expansion. It's a project that will serve the mine for a decade, but needs to be executed in 1 year, right? So, we have to take some of that pain in the AISC this year, or all of that pain in the AISC this year. But again, it's a project that sets up the mine for the next decade as it mines its reserves. So that's why the AISC at Lindero looks heavy and high, and it also weighs on our consolidated AISC for the year, right? At the mine level, those $41 million represent roughly $400 per ounce in just that one capital project that is a one-timer, right?
What quarters will be most capital intensive? Is it the second half of the year?
CapEx be heavier into Q2, Q3, so mid-year.
What do you expect the normalized AISC to be at Lindero, say from 2025?
Around $1,400, $1,400 AISC.
You mentioned in your MD&A that changes to the Argentine taxation regime on imports and export duties could affect the AISC if it's currently discussed by the Argentinian government and parliament. Could you add some color to that? Or why is that? Why could that be negative?
The current government that took office in December, the new administration, is doing a big effort to rein in inflation and create a business climate that encourages foreign direct investment, right? Now, in that process, they're sending the right message. So first, let me say that we like what we hear from the government, but at the same time, this is a government that needs to balance a deficit. So they are making some concessions on liberalizing some taxes and others. So it's still a bit of a fluid situation with what's going to be the final outcome. We've been in Argentina conducting a good business. Argentina has been a good business for us. In 2022, the Lindero mine was our largest free cash flow contributor. So, we are positive the administration is implementing right things, but in this effort to balance budgets, we might see some taxes go up temporarily or not. The situation is fluid; it's changing. We like what we see, and we believe it's for the better of the country. And but as always, we'll be willing to work with any administration.
Thank you. And then let's move to San Jose. San Jose had you did a $90 million write down. Reserves are almost, if you M&I plus reserves are at gives it a 2-year mine life. Could you summarize what is the plan for San Jose this year, and do you see any potential to turn around the asset, or do you think it's foreclosure perhaps next year?
Yes, it's important to say that most, if not all, the analysts that cover Fortuna from the different banks already assign zero to negligible value to the San Jose mine. And we did take a non-cash impairment charge on the asset, the magnitude of $90 million. But that doesn't mean that we have stopped exploring or we lost faith on the asset, right? So we currently have an ongoing drill program at a newly discovered vein named Yesi. It's a discovery made in 2023. And, we look forward to provide market updates on the outcomes of that exploration. So what's going to be the future like for that one mine? Well, it depends on exploration results to a large extent. And also, we are conducting optimization studies on additional resources that we have there, that through the budgeting exercise, we were not able to convert to reserves. But we still have high-grade zones there. So our teams are going back and looking at how we could optimize those resources, focusing just on the core higher-grade zones. And so as it sits today, based solely on reserves, we're exhausting reserves by year end. So we're updating our mine closure plans and getting ready to do a proper full-time closure. But the decision on if we go on full closure or care and maintenance while our exploration continues, or we can continue mining at a slower rate, and then ramp up, those will have more clarity in the second half of the year. If we say closure, that means closing down tailings facility, initiating remediation, lifting infrastructure. Are we right now planning to do that? We are updating our plans for if and when we need to do that. But there are multiple scenarios right now, and I'll be in a better position to answer conclusively if we go into full closure or care and maintenance, or we continue mining into 2025 with more information around mid-year.
Well, with that, I think we should move on to Keoma, the steady performer. Could you just give us a brief overview of what's to come for Keoma in this year?
Well, I think you said it. Keoma is a steady performer. There is no headache-free mine. That doesn't exist, but this one gets pretty close to it. And Keoma is delivering around 1 million ounces of silver, plus its byproduct zinc and lead, which for that mine are the main commercial products, really. So today is more a zinc, silver, lead mine, right? But it's a steady performer. It contributes free cash flow every year. So we are coming out of 2 years of also capital-heavy years, capital-heavy projects. We're doing some optimization studies. We upgraded the power line, the power substation. We have upgraded our paste fill plant. We're in the process of upgrading our paste fill plant to make it more cost efficient and help us bring down cost and bring down emissions as well. We improved our pumping capacity as the mine is going deeper to dewater the mine. So we've been facing several small projects, but on the aggregate weight on AISC for that one mine. But this year should be the 2024, the last year where we complete all of those upgrades in infrastructure and productivity optimization initiatives that we have ongoing. And the mine has a good life of reserves and resources that lead us to believe that this mine will continue to operate for a decade plus.
Excellent, thank you. Well, with that, we'll speak a little bit about your debt position and financials. So you repaid another 41 million at the end, right at the end of the year on your credit facility. So you now have 163 million drawn on it, and then a 44 million convertible debenture, which has to be will be repaid in October this year. With that, so how are you thinking of further the debt repayments of the credit facility?
As we started this conversation, we were talking about the harvesting period, right? So capital allocation is important now that we're in a harvest mode. So what do we do with the cash? We made a $40 million payment towards our credit facility in the third quarter. We followed with a $41 million payment on the credit facility in the fourth quarter. And in the early months of late February, early March of this year, we advanced another $25 million. right? So our current net debt position is $88-85 million, and our net debt to EBITDA ratio currently sits at around 0.2. So we are by no means a highly leveraged company, or we have a very modest debt level that we want to continue bringing it down, right? We expect to be cash positive on take our net debt to zero this year, right? Our net debt position is going to be zero, should be zero this year. So that's a capital allocation priority. We believe a mining company should be run with a fortress balance sheet, and this is the time to do it, right? These are the times when you look to do that, right? Strengthen your balance sheet. So that is one capital allocation priority. And the other capital allocation priority, we have three. One is bring down debt. Second, we just spoke about it, fund or organic growth opportunities, advance the high value opportunities we have in the portfolio. So we talked about Diamba Sud, we talked about exploration at Seguela, and the new discoveries that we have announced. That we talked about reserve replacement at Yaramoko, reserve replacement and San Jose, no? So we have a $40 million budget allocated to exploration this year, and over 200,000 meters of drilling. And that is a big value of creation opportunity for shareholders. And that is also a capital allocation priority. And last but not least is, being opportunistic on share buybacks. We've been restricted on acting on our share buyback due to some temporary restrictions which we lifted on our credit facility. So, we look forward to being active there. Of course, that depends on capital allocation priorities, capital projects, liquidity availability, and, or perceived valuation in the market.
Then we have actually arrived at the final question, which is, where do you envision Fortuna in 2 years?
I want to consolidate Fortuna as a 500,000 ounce producer with costs, AISCs, mines that operate with consolidated AISCs at or below the industry median, which it's a moving target, that one, but today hovers around $1,400. With life of reserves that go to a decade or beyond a decade. No, that is what we are working, and we have been working to put together. Just if you look at our acquisition of the Lindero mine, it's consistent with that. If you look at our expansion into West Africa, driven by the Seguela project, that was the crown jewel of that acquisition, the Seguela project. It's consistent with that view of assets that can run for a decade plus, with meaningful production and very competitive costs. So that is what we're trying to put together in our portfolio. So in 2 years from now, my expectation is that we will be closer to achieving a more balanced portfolio with those type of mines performing.